Today we'll be reviewing Tony Robbins' book, Money Master the Game, 7 Steps for Financial Freedom. Who is Tony Robbins? So Tony Robbins is an author, coach, and the nation's top life and business strategist. Tony Robbins is not inventing any winning strategies himself, rather he goes to the best performers in their respective fields, find out what makes them successful, and mirror their approaches and model their own behaviors. Although the book is quite dense and covers numerous aspects of financial planning, I especially want to talk about the last part, which is called the Billionaire's Playbook. In this section, Tony studied what was the specific allocation and strategies of the top 1% of the 1%, what they say, believe, and do. In my case, I will not present all of the investors Tony is covering, but only the one that give valuable advice on asset allocation. So this is the Billionaire's Playbook, and these are the 5 investors that I have selected. So first we have David Swensen, then John Bogle, Warren Buffett, Ray Dalio, and Mark Faber. They're all very well-known investors, and they're all proposing a specific asset allocation for the individual investor that you will be seeing. Let's start. So the first investor is David Swensen, Chief Investment Officer of the Yale University, which was the best endowment funds performer during the last decades. Swensen is well known for his asset allocation, especially by using alternative investment, such as private equity, venture capital, and real estate. David Swensen said that asset allocation is the only possible protection against a volatile economy, and point out that the average investor should avoid mutual fund and focus on ETFs. Swensen recommended asset allocation for the individual investors is 20% domestic stock, 20% international stocks, 10% emerging market stocks, 20% real estate investment trust, 15% long-term investment grade bonds, and 50% Treasury inflation protected securities. He also explained that there are only 3 tools that can increase return over time: diversification, market timing, and security selection. Our second investor is John Jack Bogle, founder of the Vanguard Group and creator of the index fund. So Jack Bogle is a well-known investor. Of course, he advised you to go for index fund. First, because he basically say that it's for you a diversification factor, and secondly, because it is cheaper than your mutual fund. His 4 main advice are: first, choose your asset allocation in accordance to your risk tolerance and objectives. He's basically saying that you should put half your age in bonds and the rest in stocks. An example would be if you're 40 years old, you would put 20% in bonds and the rest in stocks. If you're 25 like me, you would have to put less, which is 12.5% in bonds and the rest in stocks. He's basically advising younger people to take more risks. His second point is that, as also Swensen was saying, you should diversify more, which means that you could diversify globally and with different kind of ETFs. His third and fourth advice are quite funny but very right. The first one is that you should not do something, stand there no matter what. And the other one is don't open the Wall Street Journal and don't watch CNBC. What about that? There was a study from 1977 to 1990 about the Fidelity Magellan Fund, which delivered an astonishing 29% average annual return. In this story, by studying the fund, they realized that half of the investors in the Magellan Fund managed to lose money. What Bogle is alluding to is that people are constantly buying and selling at wrong times as the market pushes their emotion to act on fear or greed. The more noise you will avoid, the wiser your decision will be. Our third investor, and my favorite one, is Warren Buffett. He's the oracle of Omaha, and he's probably the most successful investor of all time. Warren Buffett's strategies come from his teacher Benjamin Graham, who was a professor at Columbia University. If you want to know more about Warren Buffett, I can only advise you to read either The Intelligent Investor by Benjamin Graham or The Warren Buffett Way by Robert Axtrom. These two books will give you great insight about something that is called value investing. Unfortunately, in Tony Robbins' book, it is not really covered as it mainly entered the active management section, which is reserved for professional only. Tony never had the chance to interview Mr. Buffett. However, he bumped into Buffett in the green room before the Today Show. And when Tony asked Mr. Buffett if he could sit down with him for an interview, Buffett responded, "Tony, I would love to help you, but I'm afraid I've already said everything a person can say on the subject." Tony does note that upon his passing, Mr. Buffett's portfolio is instructed the average investor to do the following: 90% in low-cost SP 500 index fund and 10% in short-term government bond. Basically, what Warren Buffett is saying is that you should bet on the US economy. Our fourth investor is Ray Dalio. He managed one of the biggest hedge funds in the world, which is called Bridgewater Associates. If you're also interested in Dalio, he recently wrote a book called Principle, which I recommend. As Tony promoted on his publicity tour, in order to gain access to Dalio's advice, one would normally need to be an institutional investor with a minimum of 5 billion in investable assets, and also your initial investment needed to be a minimum of 100 million. Therefore, getting access to Dalio's insight is sold as a key component of the book. Unlike Icahn, John Bogle, or Buffett, Tony pressed Dalio to open up and get very specific about his investment strategy, which is called the all-weather portfolio, a portfolio that can hold up in all environment, whether it is deflation, inflation, crisis, or joy. Dalio's recommended asset allocation for the individual investors, as you can see on the chart, 50% long-term bonds, 30% stocks that you should diversify globally, 15% intermediate US bonds, 7.5 gold, and 7.5 commodities. In Tony's book, he said that using backtested numbers, the portfolio from 1984 to 2013 achieved an average annual return just under 10%. He would have made money just over 86% of the time, and the worst down year would have been minus 4% in 2008. In my opinion, it's a very conservative and solid portfolio, a defensive one. With this kind of portfolio, I can assure you that you should be able to sleep well at night. Our fifth and last investor is Mark Faber. He's the publisher of the Gloom, Boom, and Doom report. He's also a Swiss billionaire and a member of the prestigious Barron's Roundtable, where, according to independent investors, his recommendation have had the highest return, almost 23% per annum, for 12 years. Faber's recommended asset allocation for individual investors is 20% in stocks, gold, cash and bonds, and real estate. This allocation overlaps somewhat Swenson and Dalio's portfolio. Interestingly, even though he published an investment newsletter, he's very willing to admit that things are uncertain and no one knows where things are headed, and that the average investor should hedge for every scenario. Very much like the all-weather portfolio. Well, so what are Tony Robbins' book key takeaways? First, Tony Robbins is always saying that we should model the best. In the investing world, it is actually possible to follow the best performers. You can just go on that website, dataroma.com. On this website, you will be able to see what stocks the most known professionals are picking. This can be a great tool if you want to start actively manage your portfolio. It can be the start of your stock picking decisions. Secondly, a lot of the masters in the book agree that there are actually high level of risk and uncertainty, and as no one can really predict the future, you should protect yourself. And to protect yourself, you would have to use asset allocation by diversifying, using asymmetric risk reward, which means take the smallest risk for the largest return. This is something that you apply for active strategies, not so much for passive. And also hedge the downside risk by having an asset allocation which is conservative, like Dalio or Swanson. There are also a couple of points that I would like to add. First, try to be tax and fee and trend sensitive, and also try to live within one's mean and save constantly. If you try to save, I don't know, 10% of the salary every month, and use this money to start to invest on the stock market with compound interest, this is how you will start building some money to maybe buy a house, or I don't know, provide for your kid education. To wrap up the presentation, I built a practical portfolio following all the investment advice of the different masters. I realized that you maybe wanted something that you could just go on your broker and apply. So for brokers, if you want to invest in the stock market, I would advise you to go for DeGiro for Europe and Robinhood in the US. These are the cheapest and the best one, in my opinion. So let's talk about the asset allocation. So in this asset allocation, we have 11% Amundi ETF, which is based in Asia. The same in India. So we have 22% of emerging markets, 22% small cap Europe, 22% value cap Europe, so 44% in Europe, 22% in the US. Well, I'm a big fan of Warren Buffett, so I advise you to invest in Berkshire shares. And for your defense, I advise you to invest in 6% in gold, in this one, SPDR gold, and also in investment grade bonds, ETF. This one, Dixor, is quite good. Well, I think this could be a good start to achieve your financial freedom, or maybe plan for, as I said, your kids' education or your first real estate investment. I wish you good luck and have fun investing, but remember, don't be too greedy.